Darren Brady Nelson, welcome back to the program, my friend.
Good to see you, Gene. It's always a pleasure to be here.
Excellent, Darren. Looking forward to chatting with you about gold. Now, you have a new position. You are the Chief Economist now at Fisher Liberty Gold. Can you tell us a bit about what your role entails there, please, Darren?
Yeah. It's largely being an economist, doing things like kind of modeling, looking at gold prices, silver prices, and the kind of things that influence it. Like inflation, various inflation indicators. Also, kind of looking at it, how it compares to other forms of investment. Obviously equities, bonds. Not so much other, I guess, at some stage maybe look at other commodities, but they're kind of a little bit different. Platinum's probably the only other kind of investment type commodity. And also doing things like writing articles about gold, kind of sometimes very explicitly, sometimes just kind of in reference, like I've talked about, for instance, Trump's tariffs, and then, what does that maybe ultimately mean for gold? And just looking at kind of interesting economic things that happen in the economy or in policy settings, and obviously trying to tie that back to ultimately what that might mean for gold and silver. Hopefully, doing some media appearances, podcasts,
Yeah.
that type of thing. Doing a lot of posts, X posts, interesting things, that pop up that are obviously gold related. Also keep on doing my other kind of economics and policy stuff too. So yeah, that's kind of it in a nutshell. They're based in Los Angeles. They're actually in Hollywood, actually not too far away from some of those horrible fires, basically.
Right.
So they're kind of actually in between Hollywood and I forgot the name, but it's one of the big famous beaches in LA. So I'll have to get out there one of these days to see the office because it sounds pretty swish. But they're also opening an office this month in Miami, Florida, which is also quite a glamorous city, if you like, kind of a much bigger version of the Gold Coast, I suppose.
Yeah. Yeah, that's the impression I always get of Miami. Not that I've been there, but it just looks like yeah, much bigger, much more high energy or high octane version of the Gold Coast, if that's possible. So yeah, absolutely. And what does
With a big Cuban sort of
yes,
edge to it. Yeah.
yeah, yes, exactly. And what does Fisher Liberty Gold do? I can invest in gold through Fisher Liberty Gold. Is that the idea? I can buy bullion. What does it do?
Well, they mainly specialize in coins, gold and silver coins. And you can kind of invest that like you can with a bullion or anything else. You can kind of usually have the option of having the physical, if you want the physical coins, or you can get kind of certificates in lieu of that. I mean, that's kind of the main thing they do. There's other, there's, the market's even bigger. You can do things like you can get certificate. Well, you can actually do futures and all sorts of. A friend of mine, sorry, I don't want to break another company, but they're not really in competition with Fisher. I think you had Jeff Dice on your show once upon a time, didn't you, in the past? Remember he ran the Mises Institute?
No, I haven't had him on yet. I'd love to have him on. I had Lawrence Reed from the not was it not
Well, you
Mises? The
definitely
other
had
one,
Mark
this
Thornton. You had Mark Thornton, who is
right.
at the Mises. He did the skyscraper curse. Remember that?
Oh, right. Yeah,
Yeah,
exactly.
yeah.
Yes.
Anyway, Jeff's, he's with Monetary Metals, and they do this like you should go check it out. They do all sorts of really innovative things with gold as well. Like you can basically they set it up so you can actually get returns, so that you don't have to just make money on gold when you just sell it, right? So they've come up with some. So the gold market's pretty interesting. Fisher is kind of just one, is a great aspect of it. It's a common. Most people actually like coins. They don't really do the bullion quite as much. Like, say your average kind of family or individual investor aren't so much into bullion as such. That's kind of, they're more into sort of coins, particularly and you can relate it back to, IRAs as they call it over here, 401ks, as part of your
Yeah.
retirement investment. So yeah, that's what they do. But kind of, I've obviously it's really opening my eye. We're going to talk about some of that, like what my eyes are open to, particularly gold being not just a protection investment, but actually a growth investment. So that was kind of something I didn't even realize until I actually crunched the numbers myself and went, whoa, wait a second. So anyway, so yeah, Fisher's yep, a growing company in a in a growing area. It's
Okay.
increasingly a growing area.
We might talk about that later. And as always, this is all for general information only, and nothing should be construed as investment advice. So, okay, Darren,
Definitely not.
why I wanted to talk about gold was I gave this presentation in Sydney before Easter. I was invited by a listener of this show, John Robertson, who's the Sydney branch chair of AusIMM, and that's the Australian Institute of Mining and Metallurgy. And I think they've been
Okay.
going for, yeah, I think they've been going for over 150 years now. They had some charter from Queen Victoria or something. Like it's a really prestigious institute. And
Yeah.
they invited me to give a talk on a pre-election briefing, and what are the issues, and so we talked about nuclear, cost of living, all of that, and in the lead up to the federal election. And because it's the audience were geologists and metallurgists and people in mining, and so they had a really interesting perspective on things. And one of the questions was something I never expected. And what this gentleman asked me, he asked, "Well, what are the implications? What would they be of discovering that the gold in Fort Knox wasn't as pure as it needs to be to meet what are called international good delivery standards, which is 99.5% pure or higher? And what would it mean for the value of the gold at Fort Knox, and what would be the implications of that write down in value for the US dollar?" And I said, look, honestly, I wasn't aware of the issue. I think in modern economics we don't really think I mean the monetary system is no longer supported by gold. We have fiat money. We haven't had any link to gold since 1971 when Nixon took America out of Bretton Woods, when the whole Bretton Woods system dissolved. Uh,
Yeah.
there's no longer the gold standard. I mean, Keynes famously described the gold standard as a barbarous relic. It was something that was unnecessary, and in fact, it was hindering the recovery from the Depression in the 1930s. So there's been a view for a long time, I think, well, at least since the 70s or possibly earlier, among economists that gold is no longer necessary. And I mean, at times, the US Treasury has sold off gold stock. It started selling it in the 70s because the link between gold and the value of the dollar was no longer there. It had gone. And so, I mean, it could be the case that there is less gold in Fort Knox, that it's not worth as much, and well, that's a loss of value for the treasury, so
Yeah.
that's a loss to taxpayers. But in terms of what it means for the dollar, it's not really a big deal. I don't think it'd be a huge deal. And that's essentially what I told him. And then after the talk, I thought, well, I should look more into this and just learn a bit more about it and discover what the issues are. And so I've had a go at doing this, and I've mentioned this issue to you, and you thought, oh, well, that's really interesting. I'll do my own research, and so that's why we're here today to talk about these issues.
Yeah, yeah. Look, in this case of the Fort Knox thing, we'll be a couple of interested amateurs
Yeah,
talking about this. I certainly know a little bit more about gold, gold pricing and whatnot, in a more broader sense. But you're right, it is a very interesting issue for sure. So, I'm going to rely, some of the think tanks that I've written for over the years included the Mises Institute, and I think I sent you a couple of links to a couple really great articles by the editor over there, Ryan McMakin. Um,
yeah.
so I'm, certainly going to unashamedly rely on some of the information that I've read by him. And to answer your question, the mystery is solved by Ryan, I believe, by the research he did, because the gold that if it's in Fort Knox or somewhere else, and we'll get into this a bit later, because not all of it's officially in Fort Knox anyway. Um, that no, the gold won't be that standard that person who asked you a question was referring to, because it came from people's coins basically, and they weren't all of that kind of equally high value. Now, at the end of the day, I'm not sure, that should lower the value if you like, if they were if you like to do an audit of Fort Knox. I mean, at the moment, I understand that officially, um, the amount of gold at Fort Knox is actually valued at the price that FDR, you know,
Yeah.
forcibly purchased it at back, in the 1930s. So, the value is obviously like 100 times or whatever that is. I think it was like $44 or something at the time, and it's like 3,300 now at the moment, or thereabouts. So the quality apparently is a bit lower. They got coins, they apparently melted it down, and then probably turned it into bars or something of that nature. We don't know. I think I think Ryan documented, and I think it's been documented many times elsewhere. It's something like 50 years ago, the last time they actually did a
Yeah.
proper actual audit of Fort Knox. But I think it was interesting in one of those two articles that Ryan did. He has some interesting statistics in there, and he has apparently, if you believe and apparently here's another interesting fact: the Treasury actually owns that gold.
Yeah.
Some people think the Federal Reserve owns it. They don't. The Treasury gave the Federal Reserve a whole bunch of certificates at that $44, sort of value, back in the day. And apparently, Fort Knox has 56% of, the gold reserves that the Treasury claims that the government has. And apparently there's a West Point mint that I never really heard of, which has 21%. Denver Mint, near our friend Tim Wanhoff,
Yeah.
17%. So, it seems like between those three sort of areas that there's, that's where most of the U.S. government's gold is by the Treasury. So, yeah, so I think, I guess you forgot to mention that there was, at least in kind of February, President Trump, Elon Musk, I think Senator Rand Paul were all kind of, calling for, or at least making noises about an audit of Fort Knox in particular. So that's also a little bit of context.
Yeah. But and that hasn't happened yet, has it? So I think the last official who visited was Steve Mnuchin, the former, Trump's Treasury Secretary in the first term, and that wasn't a full audit. I think he did a walk around or something, said, "Oh yeah, looks like all the gold's still there."
Yeah, it's like walking in the front of, like well, what's that place where you go get furniture that's horrible to put together? IKEA. It's like, kind of just
Yeah.
going in there and glancing in there and going, yeah, they seem to have a lot of stuff. Well, you got to go in and really have a look to fully, I guess, appreciate, the kind of the depth, et cetera, and scale of things. So yeah, but they've had those things where someone like a Mnuchin will walk in and, oh yeah, look, there seems to be some gold there, and yeah, it's not really an audit of any description. And I think, like if they were to do an audit, but you're right, I think that's kind of disappeared as a bit of an issue. We won't get into the Elon Trump battle sort of thing. So they're probably, I'm not sure if they're on the same page when it comes to Fort Knox audits anymore anyway.
Yeah.
Um, but yeah, they'd have to go broader than just that, obviously, than just Fort Knox. Obviously, that's 56% is still a big chunk, obviously. And but also in one of McMakin's articles, he lays out the whole interesting story about how all that gold came in there, and that was actually from private citizens, right?
Yeah.
Apparently, the New York Mint, there's another one that has some, and that's where a lot of foreign powers are keeping some of their gold in New York. But this is mainly, I understand, was that kind of forced sale. Essentially, gold was outlawed, right?
Yeah.
And effectively, even though we talk about Nixon as the official end of the gold standard, and I kind of guess it is in some ways, but really the gold standard as a practical thing ended under FDR when he did
Yeah.
that move. And
Yeah.
the funny thing is, it was driven by, just to bring it back to today, and the high level of national debt in the U.S. that was the fear back then. It's like, oh, we can't possibly afford to pay this out given the debt that we have, right? If people come and demand their gold in exchange for dollars, forget it. We're in trouble.
Yeah, yeah, exactly. So I think with Bretton Woods, the convertibility was for at the official level, so it was at the national level. It wasn't for like a foreign government. If it wanted, it could change its U holdings of US dollars into gold. That
Yeah,
was what the requirement was. But so with a full gold standard, the private citizen would be able to change
yeah,
their dollars for gold or equivalent gold. So I think that's what you're talking about. That's what FDR ended in the
yeah,
30s.
that's
It's
right.
rather extraordinary story, isn't it? Like, I mean, it was at the height of the Depression, and so what FDR was trying to do was he was worried about citizens hoarding gold, so to speak, and then he wanted them not to have. He wanted to replace that. He wanted to give them dollars instead, so they go and spend that in the economy. I think that was the logic. There was a concern about this so-called gold hoarding, and there was
Well,
a
I think it was both. You're right. There was two things. That you're right. There's that aspect and this just the practical aspect of like a run on the bank. They couldn't
yep,
actually afford to pay all those dollars, all the gold out.
yep,
So, um, and just a quick one. Apparently, with Nixon, it was almost the same thing. But you're right. It was foreign governments,
yep,
and he couldn't afford to pay them basically if they
yep.
wanted their gold back. So that's where obviously ultimately any type of gold standard ended.
Yeah, yeah, exactly. And there was a famous announcement. Apparently, it interrupted a Bonanza episode on a
Oh, how
Sunday
dare
night.
they?
I know. Well, that's why everyone remembers it. Like you'd think. That's why apparently all these Americans remember this because otherwise it's like, oh, whatever. But Nixon makes some announcement about the gold standard, about Bretton Woods. I mean, who cares? I mean, not as many people would remember the Plaza Accord with James Baker or the Japanese in 1985. Other important financial announcements. But yeah, people remember that one because apparently Nixon went on the TV and interrupted Bonanza. So
Oh.
yeah, just
So there was, in the middle of a great exchange between, Little Joe and Hoss or something, eh?
apparently, uh,
Yeah.
yeah, that's a pretty crazy story. Yeah, yeah. So August 15, 1971. Okay, it was a notable cultural moment for millions of Americans. Righto.
Oh, and by the way, apparently the debt, there was the debt fears weren't just purely because of the Depression. Apparently they were a hangover from World War One as well.
Yeah, yeah, absolutely. There's a great. I want to tell this story. This is one story you often hear that motivated the concerns that FDR was trying to address. And there's this story about this Harvard Business School faculty professor Arthur Dewing, and this is in Peter Bernstein's Power of Gold book. And this is in early 1933. He marched into the Harvard Trust Company office on Harvard Square, and he withdrew his substantial bank account in gold coins, and he placed the coins in a safe deposit box. And what Peter Bernstein writes is when the crowd inside the bank reported Dewing's actions to the people on the street, a mob gathered on the square, fighting to get into the bank to follow the example by the distinguished professor. Dewing was subsequently called on the carpet by the dean of the business school for setting such an example of unpatriotic behaviour. Dewing left the faculty soon afterwards. So, really extraordinary story, just illustrating just that concern you mentioned, that concern about the bank run and people wanting to get gold out. And so, this is one of the things that FDR wanted to stop and issued like looking at what he did. I mean, rather extraordinary rather, I mean, yeah, exceptional, possibly draconian measures in a way, but he saw them as necessary for, reducing the risk of the financial system and getting America out of the depression eventually. So that's where he was coming from. So I just thought I'd drop that story because it's a rather interesting little story about how a bank run could have started.
Yeah, I mean, look, but that also depends on the kind of school of thought that you view have of economics. That's kind of, even though, FDR wasn't officially a Keynesian because obviously, Keynes's general theory didn't come out until 1936. But that's kind of, proto-Keynesian thinking that, that kind of, government needs to step in and deficit finance the recovery of the economy, even though at the same time he's putting in all these measures that make recovery almost nearly impossible, which, by the way, he ran on the exact opposite platform. In
Oh
fact,
yeah.
he criticized Hoover for doing those sorts of things, right? Interfering in the economy, and he was going to be the one to, release the chains basically of the economy, almost like a free marketeer, almost he campaigned on. As at least someone who's certainly more Austrian school than anything, although I wouldn't strictly say I'm all Austrian school because I like Chicago, I like classical liberal stuff, and I even like some neoclassical economics. But they sowed the seeds of their own trouble, and they're trying to. There's also kind of covering their own backsides, the banks, just like they did obviously in the GFC. They created the problem in many ways, and then of course they didn't want to, pay the piper obviously for what they did.
Yeah.
So there's a multiple things going on, I guess.
Yeah.
So like in a proper gold standard, you wouldn't allow people, you wouldn't have bank runs because banks wouldn't be lending lots of money on top of the gold they actually had, right? They just lend out essentially the gold they had. There might be some at the margins given timing differences and that sort of thing, but you wouldn't be allowed that, previously before the Federal Reserve, that was considered fraud. When a bank would say, I have X amount of money backed by gold or silver, et cetera, but I'm lending out way more than that, right? Then that's actually fraudulent and you could sue the bank, and bank runs would be, sadly, a somewhat reasonable outcome, if you like.
Well,
But
that's
not for the whole
another. I mean,
system.
that
Not for the
raises the
whole system.
whole.
Sorry,
Yeah.
a bank run on particular banks that did
Right.
that. The whole system wouldn't collapse, right? Yeah.
Yes, and we're getting into the issue of fractional reserve banking
Yeah.
and ideas for narrow banking, which we might have to come back to another episode. It's a fascinating discussion. That one,
Sure.
I like that point you made about FDR. Actually, what he did in when he got into power was different from what he ran on. I mean, that just shows what a skilled politician he was. I mean, in terms of American, in terms of skillful politicians that you've
Skilled,
seen.
that's a nice word.
Well, I mean, there's no doubt about that. I mean, it's one of the
Machiavellian? Yeah,
one
I
of
guess
the
Machiavellian.
truly transformative United States presidents. I mean, whether you agree with what he did or not, I mean, he was clearly one of the best. Yeah, Machiavellian. That's probably. I think there's something
But
to that.
he did certainly, to use Obama's language, he certainly fundamentally transformed the U.S. for sure.
Yeah, well, I mean, Obama was someone I think who was Obama had the vision and he told a good story and he gave an amazing, he's a brilliant speaker, but in terms of practical impact, I think it was pretty limited, really. Whereas, FDR had both of those qualities that you needed in terms of, ability to move people and then also the ability to make government work for you. So, yeah, it was really something else.
Well, to give people the impression that that's what was happening, he actually, it's no exaggeration to say that 80% of today's federal government, like agencies,
Yeah.
came up, the FDR put them in place, basically. Yeah.
Yep. Yeah, exactly.
So, and we have that legacy today.
Yeah, exactly. Okay, so with the like you mentioned, the confiscation of gold coins from the public. The and so that means that a significant proportion of the gold at Fort Knox is actually this coin melt
I
that
think
were
so, yeah.
produced by melting down old US gold coins. And these apparently have a much lower purity, around 90%, because they've got copper, silver, other metals in those coins. And so that's the concern about it, that there's a proportion of those gold bars that aren't 99.5% purity. And then there's
Yeah.
the issue of, well, then there are other people who think that, oh, well, some of this gold's been sold and we don't know about it, or it's been lent out. And if they actually go and open the vault doors, I mean, can you imagine that? I'd love to see that. I mean, I'm surprised Trump hasn't done it. He loves the great television, doesn't he? He'd just think, this is great TV. He opens the
You would think
doors.
so.
He just
You know,
walks into this.
the orange hair and the gold. Yeah.
I can't believe he hasn't done it yet. He might have to. I mean, maybe that's where he has the reconciliation with Elon. You know,
They both they show up at Fort Knox.
yeah,
That
they
would
have
be
a
nice.
trip to Fort Knox. Oh, classic.
Why not?
So yeah, I mean, my feeling is if say it's not worth as much as that as is expected, and worst case, I mean, what if some of the gold is missing? Uh, Look, it's going to be a hit to taxpayers. So I think I've seen various estimates of it, but the estimates I've seen of the total value of US gold holdings it's somewhere between 500 to 700 billion dollars or something of that order of magnitude, isn't it, Darren? So so you'd have a write down of that. So I mean, it could be the write down could be tens of billions of dollars, say,
Sure.
which is okay. That's certainly not something that you want to have. But relative to the size of the U.S. budget, which is what is it, 6 trillion or something? I mean, the 6 to 7 trillion. The U.S. government's running a 2 trillion or $1 to $2 trillion deficit. The total debt's 35 trillion dollars or so. I mean, this is a relatively
Yeah, I think
my
it's 36. So yeah, so they could take off at best estimates not even a trillion. So you're right. So whether it's 850 or 750 billion, something
yeah.
that range is the gold. Yeah,
Yeah, so my feeling is that it's not a huge deal if there was this write down, but then there is also this issue of confidence. Like, does it say something about the confidence that would it reduce the confidence that investors have in the US economy? I mean, I don't know. I mean, that gets into psychology and I mean possibly to an extent, but I
but
still
but
don't think it's
imagine, you talked about Trump as the showman, and
yeah.
like I think Doge will, by the time, essentially a year from now, roughly, that they have their big report, I think they'll have, much more substantial savings than the stuff that they kind of put out in the press to get, you know, attention, not just to get attention, because, there's genuine things that they discover. But, the numbers haven't added up to anything humongous just yet. They're more
No.
kind of like, I can't believe that they spend money on this or that, which is
Yeah.
true. That's a thing. But, so 750, 700 to 850 billion gold, and if you said, I don't think it would be necessarily a good idea to say, well, use to pay down the debt because the debt's so massive, is that really worth it? But imagine if he goes like, this is originally came from U.S. taxpayers. I'm going to give it back to U.S. taxpayers. Imagine that. Now that would be kind of a fun thing, putting out, the legalities and all that sort of thing to side. And to be honest, I haven't thought it through very much, but imagine, dividing that amongst kind of income taxpayers to give them some sort of relief. Give them the option of actually having their gold back if they wanted it, if you can, I don't know, it could be kind of an interesting feel good sort of PR thing and also put some money in people's pockets, sort of thing. So I think that might be more fun and more useful to people than, making a tiny little indent into that $36 trillion debt.
Yeah, I mean, I have to do the sums and figure out how much gold there is to go around and what that would mean, how much would actually end up with each, every American. I mean, 330 million Americans. I don't know if I had this gentleman on my show once who had the gold backs. I don't know if you remember that.
Well, I just did a quick calculation. You get about 2,500 bucks back, so that's not so bad. If you just like evenly distributed it.
Well, right. Okay. Oh, okay.
That's
Very
something.
good.
It's like like the Australian tax.
Yeah.
Sometimes they do little sweet things like that. Give you, you know,
Yeah. Yeah. A bit of stimulus, the Rudd money that we all got.
yeah,
Yeah.
yeah, that sort of thing. Yeah.
Harvey Norman was a big beneficiary of that. Everyone went,
Now it would be Amazon. It would be Harvey Norman
yeah, that's
nowadays. Yeah.
right. That's right. Okay. Righto. Okay. So that was yeah, that was some thoughts on gold in Fort Knox. Fascinating question from that gentleman. And I mean they were super interested in this because they're all in that game. They're all into
Yeah.
mining and metallurgy. So yeah, I thought that was a fascinating question. Now, Darren, you mentioned tariffs before, and we've got all of this economic uncertainty at the moment.
Yep.
What's it been doing? What's it meant for the gold market?
Yeah, I mean, it was kind of, you know, I mean, in terms of like, gold investors should always be thinking in terms of like, years,
Hmm.
maybe decades for the most part. I mean, I guess you could make a quick buck at it, like you could a lot of things. So, in terms of that, nothing really, to be honest. Tariffs wouldn't really have any particularly great effect on that. But it's kind of interesting to see kind of some of the movements, like I remember it kind of went down a few percentage points, like when the sort of tariffs were announced, and then all of a sudden when there's the pause was announced, it actually kind of moved more like 12% or something like
Yeah.
that up. So it was kind of interesting to see these movements. I'm not sure. It's interesting, and that started to make me think like if gold was purely protection, it was moving in the wrong direction both times, right? Well, like you expect like, hey, we, in some respects, we want tariff chaos. If we're a gold investor, you know what I mean?
Mm.
Um, so the gold kind of jacks up. So, but gold kind of, I know I'm not sure if you still are a fan of we mentioned Keynes, and you mentioned his barbaric relic reference to gold, but another of his famous phrases is animal spirits, as you
Yes.
remember.
Yes.
Kind of referring to investment markets.
Yeah.
And I think, sort of in that shorter term, I think they are kind of, I kind of dismissed that concept once upon a time, and now I'm kind of coming back to it and go, you know what? At least in the shorter term, I think he's right.
Yeah. Oh, yeah.
Including in gold. And definitely in gold, it's animal spirits in the kind of the shorter periods of time, like days, weeks, that sort of thing, with the tariffs, animal spirits. But then, I'm not sure if I've really coined a great phrase in response of monetary spirits, but I think that's what kind of drives gold prices in the
Yeah.
longer term.
I think
And,
yeah, I think you're right, Darren. Now, on Keynes, he strictly speaking, he called it was the I think it was the gold standard he called a barbarous relic rather than gold. I think he's okay with
yeah,
gold
true,
as
true.
a
You're right.
yeah,
Yeah, yeah, yeah, yeah, yeah,
as
yeah.
an asset.
You're right. You're
And
right.
this
You're right.
idea of I mean with animal spirits, I mean I think Keynes is someone who actually had a lot of experience in financial markets, really. I mean he made that huge all of that money for Trinity College at Cambridge, some huge
Yeah.
endowment. And maybe partly that was insider trading. There's some suspicion that he may have benefited from information he gained as an advisor to the Treasury in the UK, and that may have informed some investment decisions.
Okay. All right.
But still, I mean that's just speculation. I don't know how much hard
They
evidence there
certainly
is.
made a lot of money, apparently. Yes.
Yeah, yeah, yeah. And I mean, the animal spirits, another way I've heard it described is a Bob Schiller, the Yale professor, he calls it, he's got a book called Narrative Economics, which is just about how a certain narrative takes hold and, the psychology comes into it, and then people all think, oh, yeah, Tesla's going to the moon. We'll just get onto Tesla or gold. Yeah, we'll go into gold or Bitcoin or whatever. So yeah, there's a lot of psychology that comes into it and animal spirits. But it's quite extraordinary what's happened to gold because it's now, if I'm looking at a legit site, it's now at 3,312 USD. Whereas the last time we
Yeah.
caught up to talk about gold, like we thought it was really amazing when it was at 2,000. And now it's well above that. So
Yeah. Yeah.
yeah.
And look, I haven't done sort of like, regression analysis, but I have modeled some of this, and as I would expect, you know, a key driver is money supply, right?
Mm,
And
yeah.
obviously, ultimately, money supply in relation to what's happening on money demand, which obviously affect what's going on in the economy, including productivity and all these other things. But generally speaking, without doing a proper sort of regression analysis, the correlation is very strong, and you see it from essentially 1971 through to today. And the fact that gold has skyrocketed, and at the same time, money supply has skyrocketed in that same period, I think is no coincidence.
Yeah.
Um, and we can maybe get into this later, but but sowing the seeds again of like how it's very good at protecting you from that from the consequences, the inflationary consequences. And it does that very well, and that's probably not a great secret. But it actually performs usually better than the S&P index too. And then when I thought about it a bit more, I was thinking, well, that's because things like GDP and the S&P itself is heavily ginned up by that money supply increases, right? The P
Mm,
times quantity type concept, right? That
yeah.
both the S&P and the GDP are driven by as well. There's essentially a price type times quantity sort of measure as well. So it should be no surprise that CPI, which is also price times quantity, goes up. But yes, the only time, when I did my analysis, the only time in between 1971 and today that the S&P outperformed gold was during the dot-com boom.
Right.
Interesting. Yeah, that's it.
Yeah.
That's
Yeah.
it.
Gotcha. Gotcha.
So that's
So,
interesting.
and who's buying the gold at the moment? It's private investors, but it's also central banks, from what I can tell. Have you been following that?
Look, yeah, I mean, you can. There are some good statistics out there. I don't have them in front of me at the moment, where you can kind of see where you can disentangle the central bank purchases and sales from, I
Mm.
guess, the rest of the market. Um, I think central banks. I'm trying to think. I did write an article back in 2020. If I can find, where I kind of found out, at least at that time, kind of what. Uh, the kind of the central banks, I think let's see, the figures were something like, this was like in 2020, I believe, when all the kind of the gold stocks at that stage were like, um, what was it, sort of, I think that, let me find it, but the central banks were something of the order of 20% of the market.
Right.
I'll get you,
Yeah.
I'll get you a better figure.
I
But
can put it in the show notes. I've just found this. There's an article that
oh, here
just
we
came.
go. At
Yeah.
the time, this is 2020.
Yeah.
Um, that yeah, it was pretty close. To that. It was at the time was 18.6%, so close to
Yeah. Yeah.
20%. So
Yeah.
like there's certainly significant players in the market, but they don't like completely dominate the market.
Yeah. I'll send you this after our chat. You may be interested in it. There's an article in Reuters. Central banks on track for fourth year of massive gold purchases. Metal Focus says. Central banks worldwide are on track to buy 1,000 metric tons of gold in 2025. Could you imagine what that looks like? Which would be their fourth year of massive purchases as they diversify reserves from dollar-denominated assets into bullion. So that's one of the things that's
Yeah,
actually improving the gold price is that these central banks are thinking, hang on, with this instability in the US, maybe we want to diversify out of US government bonds and get us some gold at a
it's kind
thousand.
of ironic, isn't it? It's like they, if you like, kind of create the problem that people are driven into gold in the first place, and get and gold prices are going up anyway, and then also the central banks themselves go, yeah, we know this is a potential house of cards that we are actually driving. We better get ourselves some gold.
Right. Yeah. So I mean, a lot
Well,
of
I
the
mean,
so yeah. So I
a
guess
thing
that's
that's
yeah. Go ahead.
just something that relates to that is, and again, we don't necessarily have to talk about this today, but there's this report that comes out every year that's, if you like the gold standard of gold reports, it's called In Gold We Trust. And that's worth putting in the show notes. And they've been, they've been better than pretty much everybody in predicting like, gold prices, and also not just gold price, but gold price, silver price, also that versus S&Ps and versus bond markets. They've been very good in kind of predicting performance in all those areas. And what I wanted to get to ultimately is they have really interesting figures, kind of, what do they think gold price is going to look like? And they do it very, as scientifically as you can do this. They give like ranges, like if this thing happens, we expect it to go to here. If these things
Hmm.
happen, we expect it over here, and they give some probabilities behind that. But another thing they do is they go like, all right, well, what would happen if, in the unlikely circumstances, we went back to a world gold standard? Well, how much could you trade your gold in at? They call that the shadow price of gold.
Right.
That's
Yeah.
really interesting. You're talking figures that go up to like $80,000 an ounce. It depends on, like, say, if the Federal Reserve wants to cover just M0 or do they want to cover M3? You know what I mean? So obviously, if they
Right.
want to cover
Yeah.
M3, the amount of, your gold's going to be worth a lot more, basically, if they try to cover all of M3 versus, say, M0 or some other, smaller and larger measures. So that's kind of a very interesting thing
Yeah,
that I
yeah.
hope
So I
to
mean,
find about.
by M0, you just essentially mean the currency or the reserves that banks hold with the Federal Reserve, which is a very small portion of the total money supply, which also
Yeah,
includes all of
yeah,
the bank
yeah.
deposits, right? So yeah,
Yeah, and
yeah,
then all the stuff in between, which
yeah.
include treasury holdings, and all that sort of stuff. Yeah.
Yeah, yeah. Oh, fascinating. I don't think I mean, it's an interesting intellectual exercise. I can't see us ever going back to a gold standard, but then again, who knows? I mean, never say never. Anything's possible.
Well,
The
I think the system's not great. I mean, well, I'll tell you why it might be possible one day, is because the whole movements of Trump, Brexit, and all those type of movements around the world are, if you like, the middle and lower classes going, this system seems to not work very well for us, right? It seems to favor the rich getting richer. This kind of crony capitalism sort of global system that we have. And, the kind of fiat money system is a big part of why it doesn't work for people in middle to lower classes very well. They go
well, look, I
backwards.
think
They're not doing so well. The 21st century has not been like a great century for people like that.
that's true. I'm not going to argue against that. The issue is how much of that's the central bank's fault. Is that I thought that would be more related to trade policy or to tax and social security policy rather than to monetary
No, but you
policy.
can't make any of that work unless you have the fiat money system. Governments could not have deficits and debts anywhere, even in the ballpark of what they have now. Um,
Yeah.
you know, the trade thing, that's a little bit different. Yeah, that's probably not quite as reliant. I think there would be a connection, but I haven't really looked at that closely. But certainly, there's a big connection between fiscal policy and monetary policy.
Right. I mean, look, no doubt about that. Another issue we probably need to come back to. This is a challenge when we chat, Darren. I mean, it just becomes super expansive, but that is a let's
Well,
cover
yeah.
that in another episode. I think that's an important issue on those linkages. The point, I guess, the fundamental point that we've been talking about is just how gold's become, it is something that seems to surge in value when there is this uncertainty, and part of it is, yeah, concerns about future inflation. Part of it's concerns about instability in particular countries. Now the central banks, they're trying to diversify out of the US. So it's all, yeah, all very fascinating. Yeah, just
Well,
extraordinary. Yep.
my point simply, it's not really that. It's driven by those things in the short, maybe medium term sometimes, depending on what the uncertainties are out there.
Right.
What I'm saying is it's driven by monetary policy mainly.
Mm,
That's what in the kind of when you're talking about like over the course of a couple of few years and longer into the decades, I think it aligns more with what's going on with monetary policy than it does with anything else that's happening in the world or in the economy. But as you said, we get into kind of broader topics because as you know, we're a couple of Renaissance men, so we have such broad interests and experiences.
yeah, I guess everything's connected. Absolutely. Righto. What else did we want to cover today, Darren? I think we've had a good go at talking about gold and Fort Knox and gold tariffs and inflation, animal spirits, and audit. Oh, one thing you wanted to talk about was auditing the Fed. Why do you think the Fed needs auditing? And what do you mean by that exactly?
Um, I think what I mean by that is, I guess along the lines of, Ron Paul's, decades of calling for an audit of the Fed. Just to, I mean, sure, look at, are there balances and are they responsible in, kind of the narrow thing they're supposed to be doing, I suppose, from, are they operating as a decent central bank? But I think what Ron Paul was getting at in a more broad sense, and I would support, is just let's really look at this institution. Is it really doing what it set out to do? And because you can clearly see that, the so-called, having a central bank to kind of smooth out all those kind of bubbles and bursts, we've gotten maybe less of these kind of frequent smaller ones, but
Hmm.
we've gotten far bigger booms and busts under the era of the central banks than we have previously in history. So, I think the statistics show that. You may not want to blame them for that. That could be, but that's kind of, if you have a Keynesian point of view, if you have a Chicago point of view or an Austrian point of view. But let's go look at it, and kind of just put that all out on the table and have those discussions. You
Yeah.
know, because I think potentially it's a very bad institution that you can't get rid of overnight or something, but you should have a look at it anyway, if nothing else.
Well,
Hold them accountable. I don't. I think it's also questionable to what extent they should be independent from governments when they are government institutions. The Reserve Bank of Australia is clearly a government institution.
yeah.
I've granted a level of independence that a lot of other agencies don't get. The Federal Reserve obviously has granted a lot of independence that other institutions don't get. It's officially a private bank, but it was established by federal legislation with a chairman appointed by the president. So, it's at least a semi government organization.
Yeah, I think from what I can tell, the Federal Reserve has much more independence than the Reserve Bank of Australia, because theoretically and under the Act of Parliament, the Treasurer could reverse or a decision by the Reserve Bank, and it could sack the Reserve Bank governor. But I don't think the US president has that power. I mean, Jay Powell's going to continue on. Donald Trump doesn't seem to want him there, but uh, I don't think
You're
he can
right.
do anything about him, can he?
You're right. They do seem to have more independence than
Yeah,
the RBA does. And
yeah.
I'm not sure about the Bank of England, for instance, but yeah, certainly the Reserve Bank seems to have less, legal independence. You can always, kind of speculate to what extent governments behind the scenes try to influence things anyway. But you're correct because yeah, Trump's not happy with Powell, and yet he's still there.
Yeah, well, Pal's basically said it. You can't sack me, can't fire me.
Yeah, he might be right, I guess. I guess so.
Bad luck. But I mean, Darren, the argument is, so how do you respond to this argument? The argument is that if you look at the data, independent central banks perform much better in terms of getting inflation under control. So there's a lower sacrifice ratio. So you get less unemployment to get your disinflation. You get a smaller increase in unemployment to reduce inflation by a particular amount. And I think that's what you see. I mean, I mean, I accept the point about central bank failures in the past. So famously, Ben Bernanke apologized to, or he told Milton Friedman he was right. Have you heard that story? So there was a dinner in honor of Milton Friedman that Ben Bernanke spoke at. It was a Federal Reserve gala event of some kind. And Bernanke said, "Look, on behalf of the Federal Reserve, I'm going to say, look, you were right, Milton. You were right about the role of the bad monetary policy in making the depression even worse." So I think there's certainly the case that the Fed has stuffed up in the past, no doubt about that. But if you look at
So wait a second. Bernanke apologized for something that was not under his tenure. He should apologize for what he did under his own tenure. But anyway, that's
no, I
interesting.
think this was before that. So
Oh, okay, right.
this was before the financial crisis. Because I don't think when did Friedman die? He didn't live to see the financial crisis, did he? I think he died around
No, yeah, I can't remember, but
2006 or '07. I can't remember exactly. Um,
yeah.
so this was actually before that. This was yeah, before all of the craziness in '08 and '09 and all of that. So yeah. So I think that's a
Oh, I think I don't know what statistics you're looking at, but the 19th century does not have a Great Depression, a GFC. It doesn't have 1970s stagflation. I think you're no. I think statistically, you could go like argue, well, it's not their fault, but a lot of bad stuff happened in the 20th century into the 21st century that you didn't see in the 19th century.
there was a 1890s depression, wasn't there? There was in Australia for sure.
These things are like these things that came and went very quickly. They didn't stick around. The Great Depression probably didn't end till 1946. So so that's a long time. That's like there's nothing like that in the 19th century. Not even close.
Yeah, well, I mean, we don't have the accurate data to make the proper comparison. But look, I accept that the Great Depression was the result of was partly due to bad monetary policy from the Federal Reserve. I'm not going to deny that, so accept that. I would argue that it's been much better. I mean, yeah, I guess the financial crisis is that's Exhibit A of your case.
Well,
Maybe it hasn't been much
one
better.
guy, Volcker, I'll say
Yeah,
he was a good central banker.
yeah. So Volcker was good. I think that was excellent. But I think the recent disinflation that we've had has gone relatively well, hasn't it? I mean, we haven't had big increases in unemployment in either the US or Australia, and yet we've seen inflation come down substantially through the
Oh,
as
well,
the
yeah, but remember, CPI is not the be end and end all of measurements of inflation. It's obviously an important one to look at, but it's not the only one to look at. And by the way, yeah, you have to go behind and look at private GDP because private GDP in the US has been garbage for like 4 years. Um, Under the Biden administration, GDP was afloat because they kept on creating more government employees and people on government largesse. Because as you know, they put government expenditure into GDP. So, you know, yeah. So
yeah
yeah, there was government employees, yes, but not really. The private sector wasn't exactly on fire over the past. I mean, the
yeah.
entire private sector. There were elements, obviously, um,
Well,
Amazon and tech and government.
yeah, well, I mean, conceptually, it should be part of GDP because it's adding to demand for goods and services in the economy. It's contributing to the circular flow of income, or it's taking money in taxes and then putting it back in. Uh,
Yeah,
so,
yeah,
so
that was a debate in the 30s.
yeah, yeah,
I, you can have that view. I don't have that view. I think
yeah.
GDP.
But look,
I think
I take you.
government's well, it's
Yeah,
double counting. It's double counting. It doesn't create any wealth of its own. So so that's nice that it grabs money out of there and demands stuff that it wants. That's a very different story from what markets might demand for the money that was taken from them. So, again, that depends on your school of thought, sort of how you view things. I don't think it's like a straight up fact that, oh yeah, GDP should have government in it, and no one would disagree with that. I mean, lots
yeah.
of
There's
people disagree.
certainly a debate. So let's another thing we should come back to. I think the point I want to make about government, like I
Actually, a quick
agree
one.
that
Did Kuznets, did he, I can't remember, did he favor government in there or not? Because he's kind of the father of this figure, isn't he?
I think he
GDP?
must have because he essentially created the modern national income accounting system. So I assume he did.
Well, I'm
We'll
not
have to
sure, but we'll go
let's
back
go.
and
Let's
read.
park that and let's come back to
Yeah,
it in
yeah,
another episode because I mean I've got my own views on that. I mean I think I would have the opposite view, but let's park that
yeah.
because I think the point you make is a good one about how a lot of the demand in the US economy has been coming from government. There's no doubt about that with the huge budget deficit. Okay,
Yeah,
that's
yeah.
that's undeniable. And in Australia, we've had a similar situation over the and I did this. I calculated this because I've been writing a chapter on Albanese and the economy. There's a Scott Prass is editing a volume on the Albanese government's first term, and that's going to come out later this year. And if
Oh,
you look
wait, what
at
about your other book? Did that come out?
that's still in process. Yeah, I'm still working
Okay,
on that.
cool.
Yeah,
Okay.
yeah. Um, basically, around half of the jobs that have been created in the last few years, the last 3 years, have been in sectors that are either directly supported by, well, they're basically government supported sectors, either government employing people directly or indirectly through all of the subsidies, all in the NDIS. I mean, the number of people that are just getting
Uh,
jobs in the NDIS, which is just a total rort, absolute. I mean, it's providing, it's helping a lot of people, but the amount of rorting in that system is just, it is. I mean, I'd be surprised if it wasn't something of the order of 5 or 10%, if not more. I mean, it is extraordinary. Uh,
Well, that's a good subject for maybe not me, but someone else, because there's a lot of evidence suggesting they aren't actually helping anywhere near as many people as the money they're spending, obviously. And I certainly got a friend who's experienced that system, and it's been terrible for that particular friend, waiting a year
right.
and a half and nothing's happening, so.
Yeah, well, I mean, what I worry about is you've got all of these vulnerable people, and there's this pot of money that government makes available, and you've got all of these private providers who are sort of trying to get hold of it. And so they, if you've got it unscrupulous, money sort of hungry private providers, they can exploit those vulnerable people. I just think it's absolutely terrible. And there's just not enough, there's not sufficient oversight because the way that they've set up the system with all of the providers, like thousands and thousands of providers out there, how's the government going to supervise that and make sure the money's appropriately spent? It's just, oh, anyway,
Well,
just
we certainly agree on that one.
yeah, yeah, absolutely. Well, maybe maybe we should wrap up on something we agree on there, Darren, and
Yeah, why
we'll,
not?
we'll come back another day. We'll talk about can government create wealth, and what's the other thing we want to talk about? Fractional reserve banking, and do central banks make the economy more unstable or
Yeah,
stable? I think there are a few good topics we should kick around.
those
All
are those
right.
are good. Yeah.
Anything you want to say before we wrap up this episode, Darren? Any final thoughts?
No, no, no. Yeah, just thanks for having me again. What episode is this for me? I think it might be, I don't know, 15 or so. I'm not
Yeah,
sure.
15 or 16, something like that.
Oh wait, 17 apparently.
Oh, very good.
Hey.
Excellent. Very good. Well, it's good to have you on and good to kick around these issues. And we'll always have a good conversation. And it's good covering some of those historical episodes too. I think, yeah, the more we look at history and try and understand what's happened, learn those lessons, the better. So it's not just a theoretical subject or a dry empirical subject. We should be looking at those historical examples for sure.
Well, and again, obviously, no investment advice whatsoever from you or I. If you're interested in gold and silver, obviously look up Fisher Liberty Gold. But also, for obviously, perhaps most of your audience is in Australia. An organization there is kind of considered one of the best on the planet. Is the Perth Mint. That they're a
Yeah.
pretty good outfit. So go check them out to learn more about gold and silver and all those sorts of things.
Okay. I'll put some links in the show notes. Darren Brady Nelson, Chief Economist at Fisher Liberty Gold. It's been a pleasure as always. I'll see you again in the future. Thanks so much, Darren.
Thank you. Bye bye.